Chapter 1. Focus on reality. If a business does well, the stock eventually follows. Warren Buffett. Do you focus on the share prices of listed companies, that is, with what other people think a firm is worth? Or do you seek to understand the economic and business realities of a business for yourself? Arguably, the world's most successful investor, Warren Buffett, thinks it is worth the effort to engage with the realities of a business to form your own view of what you think it is fundamentally worth. Buffett thinks you should seek to connect with the intrinsic value of a firm, what you think it is worth, independently of what other investors may think it is worth at any point in time. Buffett and many others think it is worth doing this because if your analysis is sound, eventually others will see what you can see, and the share price will then reflect this value. In this chapter, we look at what fundamental analysis is and why doing it is a good idea. We will see that having a framework to analyze financial statements is an important part of being able to do our own fundamental analysis of firms. We will also see there are various parties who might have a reason to want to engage with the economic and business realities of a firm. Finally, we will consider what it takes to focus on the realities of a firm and whether having a background in accounting or finance makes it easier or more difficult to do financial statement analysis well. 1.1. Fundamental analysis. Behind every stock is a company. Find out what it's doing. Peter Lynch. While some might mistakenly consider value investing a mechanical tool for identifying bargains, it is actually a comprehensive investment philosophy that emphasizes the need to perform in-depth fundamental analysis, pursue long-term investment results, limit risk, and resist crowd psychology. Seth Klarman. Fundamental analysis of a firm directs our minds to focus on reality, hard, tough, actual business reality. Fundamental analysis is about connecting to the realities of a firm for ourselves, based on our own assessments. In doing this, we also need to avoid common errors which many investors can make. A key to doing this, and to engage with a firm's economic and business realities better than many other investors, is to be able to analyze a firm's financial statements. We will also see the importance of having a framework or conceptual map on which to place the elements of financial statement analysis that we will learn in this unit. And we will see that how we use a framework will be personal to us, involving our own judgments, assessments, and downright guesses. Our own assessments. Fundamental analysis is about turning over rocks, kicking the tires, checking under the bonnet before we buy. It is about taking our time to invest, forming our own judgments, and not reacting with the herd. It is about being grounded in our own assessments of firms and having the confidence and willingness to back these judgments, regardless of whether at any point of time Mr. Market agrees with us. Fundamental analysis is about seeking to understand the realities of a firm to determine its value. It is about looking at a wide range of factors that can affect a firm's value. These include information about the economy and industry conditions, financial information of a firm, which is where analysis of financial statements comes in, and other often qualitative information. Fundamental analysis involves engaging with quantitative and qualitative information, with numbers and words, with people and uncertainty. It can involve talking with customers and perhaps mystery shopping a firm to help understand the customer experience it is delivering. It can involve understanding a firm's competitors and suppliers. It involves appreciating what is special about a firm and the barriers to entry that might help preserve a firm's distinctiveness. In our unit, we will look at how to analyse financial statements as part of a fundamental analysis of a business. We will use two frameworks to help us do this efficiently and in a way that can give us real insights into the value of businesses. The ideas and methods we will discuss are not the only way to do financial statement analysis. Far from it. It is rather a starting point on which to build in your own judgments and ideas. After all, we always must start somewhere. Our unit might be a place where you can start. There are many critics of fundamental analysis. Some critics say doing fundamental analysis on a listed company is a waste of time. They say it is irrelevant and useless since a listed company's share price will already reflect publicly available information. They say that by analysing publicly available information, such as a firm's financial statements, it is impossible to learn anything new about a listed company that the market does not already know. Indeed, they say this is what the efficient market hypothesis, a central tenet of finance theory, tells us. This criticism would not, of course, apply to the usefulness of fundamental analysis of unlisted companies in private equity markets, where there is no listed share price each day. And in relation to listed companies, we will be exploring exceptions that have been identified to the efficient market hypothesis. Other critics argue that fundamental analysis lacks credibility and rigour. They say it is difficult to use fundamental analysis to gain a better understanding of the value of a firm because it is extremely difficult to collapse the many qualitative factors of a firm into numbers to arrive at a value for a firm. In our unit, we'll be looking at ways of using financial statement analysis to help us do just that. We will see how to use financial statement analysis as part of a fundamental analysis of a firm to help us connect our qualitative assessments of the economic and business realities of a firm to quantitative estimates of value. And you'll have an opportunity to give this a go with your own firm. Although there are plenty of critics, in practice, most investors consider fundamental analysis has a role to play, that there is a place for doing in-depth analysis on firms. And because the analysis of financial statements helps us connect our qualitative assessments of reality to quantitative measures of value, it is central to any fundamental analysis of a firm. We will seek to understand how to analyse financial statements to form our own judgments about the value of businesses, to know what adds value. Avoid common errors. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Charlie Munger. One of the most baffling questions of finance is why it is possible to consistently outperform the average investor by buying shares that have low prices relative to an assessment of fundamental value. Finance theory suggests this is not possible, and that such inefficiencies in the highly competitive capital markets should be quickly competed away. But this is not the case in practice. When you are investing, you are competing against other investors for investments. If many investors consistently make errors in assessing which investments to make and how much to pay for these investments, errors which you can avoid making yourself, you can earn higher returns than many investors. You do this by allocating your capital more cleverly, more sensibly, than many other investors. Fundamental analysis is about seeking to avoid errors which many investors can make. What are some of these errors which we may try to avoid? Psychological studies suggest that when we predict the future, we can often mistakenly expect what has happened in the past to continue too far into the future. For example, if a firm has been strongly growing its earnings in recent years, we can often mistakenly think this firm's earnings will continue to grow strongly for many years into the future, and vice versa for firms with poor earnings growth in the past. Also, if a firm's shares are listed on a share market and its share price has grown strongly in recent years, we can often mistakenly think this firm's share price will continue to grow strongly for many years into the future. Or investors can overreact to good or bad news released by a firm. Or investors could fail to distinguish between a good investment and a good company. There can be prices at which buying into a good company is not a good investment. A map in our head. Some people can feel that financial statement analysis is a type of magic arts, perhaps like those skills taught to Harry Potter in his Defence Against the Dark Arts class at Hogwarts in the blockbuster novels of J.K. Rowling. And that a unit on financial statement analysis is something like an initiation into understanding a mystical black box that only the favoured few can understand and practice. But is financial statement analysis a skill that only crack sell-side or buy-side analysts can gain, operating in the major capital markets of the world or even in the lesser capital markets of Australia and New Zealand? And to which we mere mortals can only forlornly hope to aspire, but never achieve? Is it only those who are highly skilled, overly intelligent, or have native commercial brilliance who can invest successfully in the private equity markets, identifying value and extracting outrageous personal wealth for themselves and their favoured clients? It is not. An ability to analyse financial statements is potentially available to us all. There are skills in financial statement analysis that we can all potentially gain with effort and application that will allow us to be able to pick up a firm's financial statements and use them to help us engage with a firm's business realities. What we need to start the process of gaining the skills and abilities in financial statement analysis is a framework. Indeed, a key takeout for you from our unit will be the two frameworks we will use to analyse financial statements. These are the discounted cash flow, DCF, and economic profit frameworks. These frameworks are widely used by participants in the capital markets. A conceptual framework is like a map that is sitting in our head on which we can place the facts we learn. The facts you will learn are some of the technical skills we need to analyse financial statements. These skills will help us break into bits the financial statements and then understand the relationships between these bits so we can link the pieces of the financial statements back together into an understandable story. Without such a map in our head, we would have no place to put the facts we will learn about financial statement analysis. But more importantly, we would have no way of thinking about how to analyse financial statements and read and understand the stories they can tell us. Financial statement analysis is not a casual activity we can do half-heartedly. It is difficult, but it starts to become manageable with a map. You'll not be given a map in a finished form with all the elements and facts and destinations you need neatly laid out so that all you need to do is pull it out as needed. The map you'll be given is a mental one, a way of thinking, which this study guide will help you build up yourself, piece by piece. This map will also form the basis for a spreadsheet, a model we can develop into a personal tool for doing financial statement analysis on firms ourselves. The map will be in our heads. The spreadsheet will be in our computer, which we will be able to print out onto paper and will be simply a way of helping us organise the facts and analysis we make of our firms. It will be a tool to be used as we wish. Personal and imprecise. We will use the discounted cash flow DCF and economic profit frameworks as our conceptual maps that will be personal to each of us. They will be the way we think about firms, about business, about how value is added by businesses. Indeed, they will become the way we think about what adding value means and to whom this value is added. These frameworks will be based on some of the best thinking internationally by many people over many years who have thought about how to do financial statement analysis. Gradually, we will realise that using financial statements to help us engage with the realities of a firm gives each of us our own understanding of these realities and our own individual view of the value of a firm. Financial statement analysis is not an exercise in seeking to discover the true value of a firm. Rather, it helps us develop our own judgments about the value of a firm in a structured and considered way. No analysis of financial statements is correct or final. Some analyses are simply more thorough, more insightful, and more convincing than others. If we are an equity investor, we will be committing real capital based on the judgments we make in our financial statement analysis. Sound financial statement analysis will give us the basis to invest equity in firms intelligently and with a degree of confidence. Our two frameworks will not give us a magic answer to analyse financial statements, but they will give us a place to start. They will give us a sound theoretical base that is highly practical and useful. Being able to analyse financial statements, to read the stories they can tell us about the economic and business realities of a firm, is an important part of doing fundamental analysis, which is all about connecting to reality. This can help us avoid common errors of investors who do not do this analysis and so are not as well connected to this reality. We have seen financial statement analysis is central to fundamental analysis of a firm. It can help us connect our qualitative assessments of reality to quantitative measures of value. We have seen we need a conceptual map to bring together the various ideas and facts about financial statement analysis, and that this map will be something personal to us. But what exactly is a framework, and how can it help us analyse financial statements? Does not financial statement analysis simply involve calculating a few ratios, which we can then magically predict whether a firm will fail or succeed, without having to get our hands dirty engaging with the real world of business? Unfortunately, life is not meant to be easy, at least not that easy. So how do we, in practice, use the discounted cash flow and economic profit frameworks to help us do financial statement analysis? We will look at this in the next section. 1.2, a framework. If you're prepared to invest in a company, then you ought to be able to explain why in simple language that a fifth grader could understand, and quickly enough so the fifth grader won't get bored. Peter Lynch. We don't have to be smarter than the rest. We have to be more disciplined than the rest. Warren Buffett. There are many frameworks we can use to analyse financial statements. We will discuss some of these later in Chapter 3. In our unit, we will use the discounted cash flow, DCF, and economic profit frameworks as we analyse our firms. In this section, we will consider how the discounted cash flow, DCF, and economic profit frameworks can help us to connect with the reality of value creation in our firms. DCF and economic profit frameworks. In Chapter 3, we will look at several ways people might analyse financial statements. They all have a place and can be useful to use at different times and in certain contexts. However, the discounted cash flow, DCF, and economic profit frameworks, which we will use in our unit, are comprehensive, well thought through, and able to give us powerful ways to look at understanding the realities of firms through analysing financial statements. We will see these frameworks allow us to come up with precise measures of value for firms. Indeed, as we will see, the DCF and economic profit frameworks will give us the same precise measure of value for our firms. But do not be fooled by this. It is a false precision. There are many judgments, assessments, and yes, downright guesses that we will need to make in applying these frameworks in practice. Different guesses, different judgments, different assessments will give us different answers. The principal danger of the frameworks we will study is the potential for us to delude ourselves that these frameworks provide us with the means to discover or unearth the one true answer, the definitive solution to converting all the qualitative and messy elements that make up a firm's business reality into a simple quantitative dollar figure. Do not fall for this delusion. We will have more to say about this in later chapters and about the importance of having a substantial safety margin before making investments. Economic profit. The investor of today does not profit from yesterday's growth. Warren Buffett. Return on net operating assets, RNOA, is operating income after tax, OI, divided by the net operating assets invested in the business, including both working capital and non-current assets such as property, plant and equipment. We can think of RNOA, return on net operating assets, as the return on capital employed or invested in the business. Economic profit for an enterprise, or abnormal operating income, is RNOA less the opportunity cost of capital, all times the amount of net operating assets or capital invested in the business. Firms create value for their equity investors by earning a return on net operating assets greater than the opportunity cost of capital. Also, the more a firm can invest in its net operating assets at returns above its cost of capital, the more value a firm can create. In other words, growth creates value if return on net operating assets is greater than the cost of capital on new investments of net operating assets that a firm can make. Firms create value through profitability. Return on net operating assets is greater than the cost of capital, and by growth, growing its net operating assets that can earn greater than the cost of capital. We will see that the financial statements of a firm can give us a great deal of insight into the actual business reality a firm is facing. However, one of the things accounting leaves out is the cost of the capital the firm uses to fund its operations. Capital is never free. It has a cost related to the potential expected returns it could earn in alternative uses. As in life, so with capital. The true cost of everything we do is the alternative things we could have been doing with our time and energy and resources. Indeed, all of life is a trade. Because this opportunity cost is usually invisible to us, we often fail to consider it in life. If we were better at doing this, probably most of us would get quite a big shock. We often fail to realise all the alternatives and options that lie before us. All the dreams, journeys and actions we could be taking instead of what we have chosen to do. Wherever we are in the world, we can only be in one place at a time and nowhere else. And there are a lot of other places. This is the true cost of our choices in life, the cost of not doing all the alternatives we could have been doing instead. It is the same with capital. By focusing on economic profit, we seek to include this opportunity cost of capital in our consideration of the business realities of a firm. Just as it is not easy to assess the opportunity cost of what we do in life, it is also difficult to assess the opportunity cost of capital. Thankfully, not quite as difficult, as capital is at heart an impersonal commodity, which each of our lives is not. Yet, as we'll see, particularly in Chapter 7, it is challenging to assess the cost of capital. Free cash flow. Never take your eyes off the cash flow, because it's the lifeblood of business. Sir Richard Branson. Free cash flow, which we will often simply call cash flow, is a firm's operating income OI, less our net investment in the business for a period. That is change in net operating assets, delta NOA. The forecast operating income for two firms, King Enterprises and Marks Inc., over the next 4 years is set out in Table 1.1 below. Table 1.1, Forecast Operating Income. Which firm is more valuable, King Enterprises or Marks Inc.? Based on the information above, we might think both firms are worth the same because we expect them to earn the same operating income in the future. But what if Marks Inc. is expected to need twice the net investment in its business, that is investment in net operating assets, than King Enterprises each year to generate its expected future earnings? Such an issue is clearly captured in the free cash flow set out in Table 1.2 below. Table 1.2, Forecast Operating Income. In Table 1.2, we see King Enterprises is expected to generate higher expected future free cash flow than Marks Inc. Although both firms have the same expected operating income, King Enterprises expects to invest less each year to achieve the same earnings growth as Marks Inc. In this way, expected future cash flow may give some insights into value creation by our firms that expected future economic profit based on accounting earnings may not. However, cash flow in any given year is not a good measure of a firm's performance. Indeed, cash flow is not a measure of value add for a period. Free cash flow could be easily increased in any year by simply reducing net investment. By contrast, economic profit is a direct measure of value add, being based on a firm's accounting profit for a period compared to its cost of capital. Both economic profit and cash flow can play a part in helping us connect to how a firm is adding value to its equity investors. The key thing to remember is that we need to focus on what drives cash flow and economic profit. The two key drivers of expected future cash flow and economic profit, and of value creation in a firm, are expected future profitability, return on net operating assets relative to its cost of capital, which drives both cash flow and economic profit, and expected future growth in net operating assets. To calculate discounted cash flow, DCF, for a firm, we need to forecast a firm's expected future cash flow. And to calculate economic profit for a firm, we need to forecast a firm's expected future economic profit. Your task will be to take the DCF and economic profit frameworks and adjust them to make them your own. You can take from them what you will. There is a lot of good thinking that has gone into these two frameworks, and we can add our own and others' thinking to it over the years. There are also many other frameworks and approaches for valuing businesses we can use as well. There's only so much I can or want to put into one unit. This does not need to limit us, to put a boundary or constraint on where we can go. Rather, it is designed to get us started, to use good thinking from accounting and finance to help us start to connect with the real world of business. In this section, we have seen the value of having a framework or conceptual map on which to place the elements of financial statement analysis that we will learn in this unit. In Chapter 3, we will look at several ways people might analyse financial statements. They all have a place and can be useful to use at different times and in certain contexts. However, the discounted cash flow, DCF, and economic profit frameworks, which we will use in our unit, are comprehensive, well thought through, and able to give us powerful ways to look at understanding the realities of firms through analysing financial statements. We also saw these frameworks allow us to come up with precise measures of value for firms. Indeed, as we will see, the DCF and economic profit frameworks will give us the same precise measure of value for our firms. But do not be fooled by this. It is a false precision. There are many judgments, assessments, and yes, downright guesses that we will need to make in applying these frameworks in practice. Different guesses, different judgments, different assessments will give us different answers. The principal danger of the framework we will study is the potential for us to delude ourselves that these frameworks can provide us with the means to discover or unearth the one true answer, the definitive solution to converting all the qualitative and messy elements that make up a firm's business reality into a simple qualitative dollar figure. Do not fall for this delusion. We will have more to say about this in later chapters and about the importance of having a substantial safety margin before making investments. We will next look at how we will be focusing our attention on the operating activities of our firms, and that there can be many points of view when considering the economic and business realities of a firm, and how this will necessarily involve us making value judgments.